When starting or growing a business, you're gonna need cash. Cash to cover your startup costs, marketing expenses, hiring employees, operational expenses. The list goes on and on and on. For some business owners out there, it may require nothing. For others, you can simply make it work with what's out of your pocket. But for many, you're gonna have a time where you need to get additional funding to help your business grow. The issue is, there's a lot of very different funding and financing options available to you as a business owner, which means there isn't a one-size-fits-all approach to getting funding. Before we actually dive into the funding types, we just wanted to mention that we're going to be covering this a bit differently than most other resources you've seen before, because really what's important is that you understand the different funding types holistically, so that you can understand the differences and how each can function and how it may impact your business. We're going to be breaking this down into 6 different funding options: bootstrapping, loans, investments, crowdfunding, grants, and prizes and gifts. Number 1, bootstrapping. A common term that you've likely heard of that's associated with entrepreneurship is bootstrapping. And we wanted to cover this one first because while yes, it is a type of funding, it's a bit different from everything else we're about to cover. And that's because it really is you reinvesting the revenue you make as you run your business right back into it to keep things growing and running. It also can represent you investing your own money into the business. That can be your credit cards, personal assets, or anything else that you can bring to the table. Basically, it's you doing anything and everything you can to get your business up and running. That may mean taking no salary at first. For many business owners, no matter what business stage you're at, you're going to be doing some level of bootstrapping at some point in time. Number 2, loans. So the thing that you likely think of first when getting funding for your business is going and getting a bank loan. Now, there are a bunch of different options out there that vary on terms and other things based on the institution that you're working with. So today we're going to keep it simple and stick with 4 of the most common types that you're going to come across. Let's start with just a traditional bank loan. While lending standards have become stricter over time, there are often funds set aside specifically for small businesses, but it fully depends on the lender that you're working with. So to help you simplify your search, you'll typically have better luck talking to a real person if you go to a local bank or credit union. And remember, the terms are going to vary wildly based on the institution that you're working with and the loan type that you're going for. So shop around, have conversations, and make sure that you find the best fit for you. When you're first starting out, the first thing you may do is look close to home and ask friends or family to help fund your business. While going this route isn't like going through a traditional bank or investor, you should treat it as such because it'll help you and the other party be held accountable throughout the entire process. Let's hand it off to Trevor, our CFO, for additional insights into how to handle friends and family when you're getting funding from them.
Yeah, if you're doing friends and family financing, you got to make sure you still treat it like it's a real thing. You can't just have, someone hand you a check and then you give a, handshake agreement. So, you still need to make sure you have a lawyer look at it, ideally, that you have documents drawn up, that you have something notarized. That way you're treating it as if it were a bank or someone more professional giving you a loan. Because what you don't want to have happen is later down the line, there's a question, there's a concern, you don't want to ruin relationships. It's a good opportunity to do friends and family financing because those people know you, they trust you, they have a passion for what you have a passion for. And so oftentimes it is easier to get that kind of financing by not having that, that paperwork and that actually official situation, then you can get into trouble that way.
So yeah, you want some sort of legal arrangement in place that showcases the agreement that you and your friend or family member made. That way, if things go south, it doesn't damage the relationship you have with that person. Another loan type that you've likely heard of is an SBA loan. Now to clarify, this is not you working with the Small Business Administration to get a loan. Instead, you're getting an SBA-backed loan through a traditional banking institution like a bank or credit union. The way this works is that the SBA sets lender guidelines that help small businesses get funding and reduces lender risk. There are a variety of SBA-backed loans, including some that are specific to disaster relief or from a few years ago, COVID relief. Now you can ask about SBA-backed loans during your traditional bank search, but it may be easier to go to the SBA's website and check out their SBA lender portal to see what banking institutions in your area may be able to work with you on getting an SBA-backed loan. If you're unsure you qualify or you've applied and been rejected in the past and want to improve your chances, we have a few articles on the B-Plans website linked below that you can check out. You can also connect with somebody from your local SBDC to help you get additional guidance. So these last few loan types are a bit more specific and typically come in smaller amounts. First up is inventory loans, which is exactly what it sounds like. It helps you either purchase or maintain inventory. And then you have microloans. Again, exactly what it sounds like. These are loans that are smaller amounts, typically have to be repaid in a smaller time frame. The thing to keep in mind with these types of loans is that there are going to be limitations about how much money you can get and often what they can be used for. If you have a short-term project or inventory or something else in mind that you need to get off quickly and don't mind repaying it back in a shorter time frame, these can be a great option. So we just covered a handful of different loan types. Now, keep in mind, this is just a sample size of the different types of loans that you can expect to see as you start to explore your options. But remember, a loan's a loan, and it really just comes down to the institution that you're working with and the terms that you can expect. Number 3, investment. So if you're seeking out investment for your business, keep in mind this is going to be very different than taking out a loan. With a loan, you have to repay it over time. With an investment, you are selling a portion of your company to the investor. And while your mind may jump to an investor being a guy in a 3-piece suit trying to throw money in your business to try to take it over, there are actually a bunch of different types of investors that you can get money from. So first, let's bring it back to friends and family. Just like if you take a loan from a friend or family member, if you're getting investment from them, you need to put down some sort of legal documentation to mark the agreement. That way, again, if things go south, you are both accountable for what happens and it doesn't ruin the relationship. Next, you have venture capitalists. These are investors who provide capital to high growth potential businesses in exchange for a portion of their business. Now, venture capital is hard to obtain. It actually only accounts for 1% of funding for US small businesses. But if you show strong initial traction and interest from customers and have high growth potential to either expand or grow into a larger company, there's a good chance that you can gain interest from investors. The main drawback that you're going to need to consider if you are going after investment is that you are likely going to have to give up a large share of equity in your company in exchange for the support. That can lead to a loss of control and potentially a faster exit so that the investor can get a larger return in a shorter time frame. Now, unlike shopping around for a loan, it can be really difficult to find investors to even pitch your business in the first place. So to help you out, check out the SBA's investment finder through the link in our description. Similar to venture capitalists, you also have angel investors. These are typically individuals or groups that have extra cash that are willing to invest in promising young startups or expansions. Let's go ahead and hand things back over to Trevor to see what he has to say about angel investors.
Yeah, angel investing is also a great way to get funding for your company. And if you think about the types of companies, even ones that we're familiar with, like Amazon, they may have started with friends and family loans, which is my understanding that they did. But the next series is you do angel investing, which if you're not familiar, angel investors are usually people in your local community that have funds to invest and they're interested in entrepreneurship, but they're not doing it at the scale as like a venture capitalist. So, they might be putting in $5,000 or $10,000 and pooling their money together to help out local businesses that have great ideas, but just lack the funding. And so, that angel investing could come in the form of regular investment, or it could be debt financing as well. So depending on the situation and the type of industry that you're going into, a good example that's kind of pretty common to a lot of people and might be more familiar with is like Shark Tank. So, someone goes on to Shark Tank and they're maybe looking for an investor to help grow their business, purchase more inventory, to scale more quickly, to increase their marketing reach. And, those investors, which are very similar to like an angel investor, they might say, you know what, I know you're looking for, $50,000 for a 10% stake in your company, but instead, that's a little too risky for me. Maybe I'll do a loan. And maybe if that loan goes well, we can convert that loan to equity, which would be more like an investment. And so there's definitely not a one size fits all. It just depends on the situation, depends on the type of business, depends on the risk involved, depends on the opportunity that might present itself, and it just depends on lots of many factors. So as you're looking for the different kinds of financing, which could include angel investing, just make sure everybody at least is aware of the different possibilities that you could structure things.
So yeah, angel investors are investing or buying a piece of your business. They're typically just investing smaller amounts and often at an earlier stage than venture capitalists will. They're willing to wait a bit longer and maybe even take a bit more risk on businesses that they think are a good bet. If you're wanting some sort of investment that gives you a bit of mentorship and are willing to give up some level of control, you can seek out an angel investor. Again, like venture capitalists, it can be difficult to track them down to even submit a pitch. So check out a few of the resources that we have linked in the description below. 4, crowdfunding. So another option that you may be familiar with is crowdfunding. Crowdfunding is sourced through a website where you create a specific page and promotional materials to attract people to invest in your product or service. So the thing with crowdfunding to keep in mind is that you're technically accepting some level of pre-orders here. You may have an MVP or some other mock-ups, but don't have the product or service fully developed yet. But you're asking people to invest in the promise that you're going to deliver something at a later time. The thing to consider is that that can lead to you being stuck fulfilling these orders for a long time. It may even lead to the point where you're not able to take on new customers until you've finished, or put yourself into a position with cash flow where you run out of money by the time that you've completed all these orders. So one thing you can consider is using this as one of your funding options to showcase initial traction. This can potentially help you get a loan, convince an investor, or generally just have a better sense of who is going to buy from you. Now, there's going to be a handful of different crowdfunding sites available to you, and they all differ in how they operate, the different revenue share options they have, and a bunch of other details. So be sure to read the fine print and compare options to make sure you find the option that's best for you. 5, grants. We're putting grants on this list because they're often grouped with the other funding options we've already gone through. The reality is, grants are incredibly rare, especially for for-profit businesses. Now, if you're a nonprofit or you happen to be in the science or medical industry, there are actually more grants available to you, and it can be a viable source of funding. The point we're trying to make here is grants are rare, so don't try to focus on them as a guaranteed funding option. Even if you do think you qualify, keep in mind that there are going to be very specific requirements that you have to qualify for and adhere to. And there may be even specific use cases for the money that you have to consider and take into account. So that being said, it never hurts to keep grants in mind and in the back of your head as you're pursuing other funding options. Lastly, prizes and gifts. Prizes and gifts are a no strings attached type of funding that can come from friends or family, or business plan or pitch competitions. The amount you get is often incredibly small, typically like a few $1,000s or even less. And like grants, they're gonna be incredibly rare, so don't go into business expecting that somebody's just gonna hand you money. If you do happen to get something, be sure that you account for it as cash flowing into your business. Something to note is that your personal credit, it's gonna make an impact on virtually every single funding option that we talked about today. For example, loans and credit cards are going to require good credit and assets to back it up. Angel investors and venture capitalists will not always require assets or be looking at your credit score. That being said, they will do due diligence on the founders and anybody else that's directly involved with the business. Bad credit is simply not a good look when you're trying to fund your business. So be sure that you have your personal credit in order as you start to pursue funding. So there are the 6 most common types of funding available to you as a small business owner. Now, we didn't get into the nitty-gritty of every single type of funding option available to you today, but that's something we can go into in future videos. So be sure to subscribe and let us know which funding option you want to know more about in the comments below. The last few things we want to leave you with today is that to succeed with any of this type of funding, you really need to have a solid business plan to back up your applications or the business pitch you're giving. And if you're talking to investors, you're going to want a pitch deck and a really tight elevator pitch that consolidates that business plan so you can convince them in the moment. Now, putting together any of these things can be incredibly daunting, but luckily we have a bunch of excellent resources on B plans that you can check out right now. Be sure to like, subscribe, and turn on your notifications so you don't miss any more tips on how to start, plan, fund, and grow your business. Thanks for watching.